Are you investing in dividend ETFs? Dividend ETFs give investors a wide exposure of dividend stocks. Now, the funds can generate steady cash flow, which is awesome, and of course, a little bit less risky than growth ETFs. While dividends don't always beat the market, they have a tendency to be a little less volatility with a little bit more of the dividend portfolio. In today's video, we're going to be looking at two different dividend ETFs and breaking down exactly how they work and which one is the best out of this. Now, the first one we look at is the iShares Core Dividend Growth ETF. This is a ticker symbol of DGRO. And of course, my favorite, the Schwab US Dividend Equity ETF, or the SCHD. Now, these two ETFs are absolutely top performers in the marketplace. So wondering which one you should pick up? Let's explore what it looks like on long-term returns, portfolio allocation, and really breaking these down to make an informed decision on which one you should look at. So the big thing about these two is even though they are both dividend ETFs, they have a very different investment philosophy, which is what I want to look at. So they both invest in dividend stocks, but they do it a lot different. When we start looking at the DGRO, it prioritizes dividend growth stocks versus dividend paying stocks themselves. Now, these companies tend to have a little bit of a lower yield than average, but they do tend to grow dividends faster and at a much higher and faster rate than most other corporations do. Now, the other side of this, of course, it also outperforms the SCHD, and that prioritizes this one in the way that the methodology that they use when they are doing this ETF. Now, on the flip side, looking at that SCHD, they look at dividend sustainability and really looking at higher yields than we're seeing. So one is going to be focused a lot more on growth when it comes to dividends and really that dividend increasing. The other side is going to be focused on that higher dividend yield. But of course, they have a lot of stocks in there that do underperform the S&P 500. And of course, it does come with a little less volatility with the SCHD, but you could also miss out on some additional returns when it comes to that bullish market. Now, while the SCHD focuses on the dividend sustainability, the DGRO examines how much the dividend is growing, and that is again where fundamentally they are different. Plenty of stocks in the SCHD yielding above 3%, which is good. Dividend growth rate is below 5%, however. And on the flip side, like I said, with the DGRO, they have yields under 1%, but an annual dividend growth rate of roughly 10%. And that, of course, is a really, really big difference. So let's take a look at these two powerhouses side by side to do a comparison. All right, guys, so for this one, we hop over to ETF.com, comparing the DGRO versus the SCHD. Now, of course, these are two really big dividend stocks. These are two of the most popular that we do see. So looking at the price itself, you can see that the SCHD is significantly cheaper than we see that iShares Core Dividend Growth ETF, making a big difference. Now, when you're looking and investing, you can actually buy fractional shares or you can buy full shares. And you'll also notice that there is a higher expense ratio with the iShares, and also assets under management are almost double for the SCHD, meaning there's not going to be any liquidity issues. But the big thing you'll notice right off the bat is number of holdings. When we start looking at the BlackRock one, they are holding 415 companies within that growth ETF. Within the equity ETF, they are only holding 101. So when you think about this, if you're one individual that is looking for diversification, the DGRO does have a lot more diversification. I mean, you're talking almost 4x than what the SCHD does. But of course, when we start looking at dividend yield, that's where it does change it out a little bit. So looking at the cost itself, again, a 0.02, really negligible when it comes to the expense ratios. You're not looking at 0.5% or a full percent, really making a big difference. But you'll also notice the SCHD does trade a lot more, looking at almost a 4x or a 3x volume right there when it comes down to actually the trading on a regular basis. Now, the interesting thing that I want to break down right here is the SCHD and the DGRO performance. Because remember, one is based on how fast the dividends are growing. One is based on the dividend yield that we have within those companies. But then again, when you start looking at the growth rate, you can see the 1 month, we are beating it out right here with the SCHD, performing a little bit better, a little bit more flat even here. I mean, 1.5%, so a little bit of growth. Year to date, they are almost dead even. I mean, you're talking about a what? 0.14% growth, not really a big change in there. But then we get into the 1 year versus the year to date. So remember, year to date is 2025 only, which I believe at this point, 2025 might even not have the information as it sits right now. I didn't see exactly when the reporting of this was, but looking at the 1 year, 17.63, that is a really big increase over the 13.41. So when you start thinking about growth itself and the overall return, the DGRO is a much stronger combatant. Even looking at the 3 year, 8.37. But interesting enough, when you get to the 5 year, you can see the SCHD over a 5 year term returned 11.5%, which is beating out the DGRO, which of course, again, is focused on the dividend growth, not the dividend yield. Now, of course, the holdings do make a very big difference. Looking at the top 10 holdings, and interesting enough, because you'll notice right down here, when we're looking at the ACH or the SCHD, BlackRock 4.4%. That is what the DGRO is through as BlackRock. So they are holding the company, or essentially the competition if you're thinking of ETF versus ETF. But you'll notice that there are really some of the very same things in all of these portfolios. Breaking it down, JP Morgan Chase, now a lot of equity and a lot of financial institutions are always on this list because they have been known, and historically they do pay a pretty good dividend. They do grow the dividend pretty quickly, and a lot of these dividend equity ETFs or dividend ETFs in general do hold a lot in the financial sector. Now, also remember, we have 400 plus companies that are in the DGRO, while we have 101 in the SCHD. So thinking of some of the big names that are paying, Home Depot, very, very consistent. UPS in here. We have Verizon Communications, which we know is paying a decent yield. So overall, looking at a higher yield, but not to the point where you're really not diversified or you're entering into holding too much of one company. When we start thinking of the S&P 500 or even the NASDAQ, where it is very heavily weighted towards one company, they're pretty even with everything that they have in here, looking at, again, mathematically what they are breaking down. But then we get into the sectors. This is, again, where it gets pretty interesting because, like I was saying, you can see the finance sector. The DGRO holds 37% in the finance sector. So you are talking, almost or well over a third of this portfolio is in the financial sector. So, of course, could be very, very volatile when it comes to rate adjustments, rate changes when it comes to government regulations, because of course the finance sector is heavily regulated. Then you look at the healthcare side making up another 28%. The electronic technology, another 28%. So there's a pretty big chunk right there. So again, when you think of the amount of holdings they have, the diversification outside of the market sectors is not really there. Where you see the SCHD, they're pretty even kind of across the board, even holding almost no utilities at all. Even health service is the exact same. They're literally at a zero for some of these. But then we start breaking into the sectors themselves, and you can see when it comes to even holding just those 100 stocks, there is a little bit more of a diversification. They're not so heavy into finance and health technology, electronic technology. They are a little bit more diversified and a little bit more split across the sectors when it comes to building this out. And you'll also notice the price to earning ratio a little bit lower on the SCHD. But then we look at the distribution yield, 2.28 versus 3.5%. So if you're looking at an ETF to actually grow and looking at one in its entirety, kind of bigger picture, it seems like the SCHD is a very, very strong component when it comes to growth. Now, me personally, I do hold the SCHD in my portfolio. I hold it at about 30% of my entire portfolio because the way that I break it down and the way that I think about it when it comes to actually having now a 4 ETF portfolio is I do have my growth sector, which of course is my QQQM. That is going to be the strong, that is going to be the heavy tech side. That is going to be the risk allocation of the portfolio. The second portion I hold is the SCHD. Like I was saying, roughly 30% of the portfolio. This, of course, is going to be my dividend. Not only are we going to see some growth out of it, but we're also going to see a good dividend yield, a good income that's coming from that. And the final one that I have is the Vanguard S&P 500, which is the VOO in that 3 ETF portfolio. And if you've seen the update that we did before, we did allocate 5% to the Bitcoin ETF. That way we do have some exposure within the portfolio into cryptocurrency itself with the Bitcoin ETF. When it comes to cryptocurrency and really ETFs, you have to have a strong understanding of blockchain technology, know exactly what you're investing in. Don't just go in blindly without knowing. So overall, guys, looking at the video, I would say the SCHD I would choose over the DGRO. Very strong comparison. And honestly, the performance of the iShare Core Dividend Growth ETF is pretty solid. But when we start looking at the 5 years and the SCHD is breaking it out, it is giving more of a dividend yield. It has a lower expense ratio. And of course, I like the diversification across the sectors that it does offer. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think about these two ETFs. And as always, thank you guys for watching.